You've been watching BlackRock Chairman and CEO Larry Fink speak at the Economic Club of New York with our very own Eric Schatzker. This, of course, as we see a sell-off, a third day of sell-off in U.S. equities. And as always, Katie Greifeld is here with me because normally this is Monday and we cover ETFs, but I just want to go over some of the headlines here from that conversation. Larry Fink saying the economy is weakening as we speak, and in fact, most CEOs he talks to believes that we are already in recession. Pretty striking given just about a month and a half ago, everyone was saying this is the continuation of a great economic expansion.
Yeah, not exactly soothing words from the CEO of BlackRock. Again, the economy weakening as we speak right now. I also thought it was very interesting to hear him say that he views this as a long-term buying opportunity, but that doesn't mean to buy right now. He also wouldn't rule out another 20% market decline. We're already flirting with bear market territory when it comes to the S&P 500. And I mean, looking at Larry Fink's crystal ball, maybe there's another 20% to go. But this is ETF IQ. So let's look at this market sell-off through that lens. And as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, thank you very much. And, you know, interesting, the flows point to what you talked about with Larry Fink. He said long-term buying opportunity, didn't say it's guaranteed to go up from here, but he did talk about how he would not take money off the table. He's generally a long-term bull. I think that's why. If you look at the flows, they show a lot of the same. A lot of Larry Fink's comments in here amongst the retail investors. This is the two-day flow. So this is like post like the big tariff announcement. Look at these flows. I mean, pretty big. $5 billion for SPY. $3 billion for Q. Now, there is some money going to treasuries and gold. So some people are buying protection as they buy beta. VU still doing the VU thing. And even the degenerates over here are buying SOXL, which is 3X semiconductors. Let's look at the outflows. And what you're going to see at the top here is a lot of sectors. So a lot of sectors rotation going on. XLF and XLE will lead the outflows when we see that. And then you're looking at the numbers are a lot smaller than they would be in the inflows. So net, we're looking at about $15 billion into ETFs. Most people still buying. Now, let's look over here at the chart of SPY volume. We like to look at SPY volume as sort of the people's fear gauge. And yesterday, we saw the second biggest day in volume, 113 billion, I believe it was, the biggest day since the biggest day during COVID. So that's how crazy it got, right? And today, it's already 80 billion, which means it's probably going to break the all-time record today, as many people are out there tweaking their portfolios. Katie, that said, the Vanguardian investor staying long.
All right, Eric, I'm going to pick it up from here because we want to start our conversation right now with Phillip Toews. He is CEO and portfolio manager at Toews Investment, or I should say Asset Management. And Phillip, you've been pretty pessimistic, and you continue to be pessimistic. In fact, last October, you coined the phrase MAGA, which is Make America Depression Great Again, and is something SNL ripped off over the weekend. And it really has to do with tariffs and how it's going to depress the economy. Is this kind of the worst case scenario for you right now?
It is. I was in disbelief, like most of us were, when we saw the big board come up and I saw the percentages on that. So I haven't been pessimistic altogether unless the tariffs got done. And we were all in this land of the unknown about whether we'd see them and how much they would be. So in terms of what it could be and what it is, I think, yeah, it looks really pessimistic right now.
Yeah, I got to point something out. So today there was this little bit of fake news that came out and the S&P went up 7% in like a couple minutes, it seemed like the algos were just lying in wait. It seemed to me, is that showing us that all of this selling is that fickle? Like, if we get one positive headline, are we back off to the races? That's what that tells me, but maybe I'm wrong.
So I wouldn't say that it's fickle. I would say that people are so desirous to not have these tariffs. It shows the implications of everyone's wish, and I think it's still not, tariffs still aren't fully priced in. So if there's any indication that this is all sort of like a joke or it's going to go away soon, markets are going to rally super strongly.
Yeah, we're clearly trading on a hair trigger here. When you take a look just at the intraday chart of the S&P 500, I think it was Neil Dutta who said that the S&P 500 is trading like a fart coin. Those are his words. They aren't mine. I think they're gross. Anyway, I want to talk about how investors are actually investing, and I want to talk specifically about buffer ETFs. There's been a really heated debate over buffer ETFs. You had AQR coming out and basically slamming them.
Right.
I want to hear your opinion on how they work and what they might actually be doing in this market.
Okay, so what should they be doing? They should be trying to limit losses, right? And I don't necessarily agree with all of Cliff Assence's of AQR's assessments about just hedged equity generally, but a perpetual problem with buffer ETFs is that, number one, they have a cap and that can limit gains in some cases down to inflation gains over the long term. But what we're seeing right now is the other end of that, which is that, it feels like if I protect 10% of my portfolio or this ETF, I'm good because we don't perceive big downturns like we have right now. But what's happening right now is that a number of buffer ETFs, including the most popular, have broken below their lower buffer levels. So at this point, any investor who put their money into these things to try to prevent losses has unlimited losses from this point down.
Why is that? I mean, they were designed to use options to cover their losses to a preset level. That shouldn't happen, right?
Right. So they are designed just to protect a certain. That's the word buffer. It means we're going to buffer you against the first X% of losses. Now, a lot of them, the most popular, protect against the first 10% of losses. There are also buffers out there that protect against 15, 20% or unlimited losses. But that's where a majority of the assets live, in this 10% buffer level. And so below that, they're designed to experience losses.
So, and let's be clear, yeah, the buffer, they're working. They're just the ones that only protect a little don't really anticipate how deep it can go.
Exactly.
That said, there are 100% downside protected.
Exactly.
And I would like to get your take on this. You're an older investor. That psychological feeling of knowing that you are locked in,
right,
or at least protected, that is different than all these other hedge strategies like yours, which you may get some buffer. You can't guarantee it. The guarantee to me seems like the selling point here.
It exactly is. So it's an imperfect product with a great marketing pitch, which is that we're going to understand exactly what we get in advance. It seems like it might be a good idea. But when you apply it to its main objective, which is for a portion of, especially a retired person's portfolios, protecting against downside, it's got to work in a crisis, right? During the worst case scenarios, that's when you've got to have a hedged equity solution.
So it sounds like these buffer strategies are appropriate when markets rise gradually and then there's just occasional drawdowns.
Right.
But it's not really a tool for big sell-offs that are driven by panic.
Exactly, right. And also what's interesting is if you look at them and the caps that are involved, they're also not designed for super high returning markets.
Right. Well, that's where I wanted to go. I mean, okay, so when you get that 10% drawdown, that's when you start to experience unlimited losses. Sure, and I think that, I would hope that investors investing in these products understand that, but what happens when they have to reset the protection? Tell us a little bit about what happens, what the implications for that rule are.
Yeah, so thanks for asking, because a worst case scenario for a buffer is that you both have a significant loss break below that lower barrier, and then it rolls and it's capped. So now, where normally in an equity market you'd be participating in a huge rebound, you could cap that rebound, so in a way, you're locking in the loss. So I don't want to be overly ravaging of the buffer space, but it's something that you know in advance, and you just hope that losses aren't that deep and fast to ever experience that, but it's a possibility right now.
All right, unfortunately, we are up against the clock and have to leave it there. Really great to see you, especially in studio. That is Phillip Toews of Toews Asset Management. Now, quick check on these markets. A lot of activity, trading volume off the charts. The S&P 500 still down on the day, down about 1%. We were down by more than 4% at one point today. Then we were up quite mightily. Now we've seemed to settle at these sort of levels. We'll continue to keep an eye on these markets. This is ETF IQ. All right, welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with HYG. It's one of your biggest junk bond ETFs. We've seen trading volume explode across asset classes, and junk bonds are no exception. We're taking a look at put volume here. So protecting against downside, maybe making a directional bet. You can see that put volume on HYG absolutely through the roof. We'll continue to keep an eye on that one, but we're also keeping an eye on crypto and its correlation or not with the stock market. You have SPY in white, you have IBIT in blue, and you can see that IBIT has done a bit better, and maybe that correlation snapping back a little bit more as the selling continues. And speaking about selling, let's end with leverage ETF, Scarlett. I want to look at an intraday board of performance for some of the biggest leveraged ETFs. And as you would expect, there's a lot of red on that screen. Of course, they make for a really fun trade when everything is going up. But when things come down, it can get a little painful.
It can get a little violent. All right, Katie, let's talk about this more with Bloomberg's Vildana Hajric, who's been keeping a very close eye on these ETFs. And certainly volume has gone through the roof for these levered ETFs. They were very popular during the bull market run, and they remain popular as we see the bull market disintegrate and lapse into a bear market.
Yeah, if we look at trading volumes for levered and inverse ETFs, they're hitting records in the last couple of days. And I just think it speaks to this moment in particular because we have had a proliferation of these funds. They're super popular with institutions, but also particularly with day traders, retail traders, people who are trading them on their own. And so I just think it speaks to the moment because if you have a lot of volatility, you'd sort of expect to also see, heightened volume, heightened turnover for the types of products that are specifically giving you 2 or 3x a company or an index.
Yeah, what is fascinating to me is we just talked about the Vanguardian investor. It's really hard to shake them. These degens are also hard to shake. And I look at TQQQ. This thing has taken in $3.2 billion in the past 4 weeks. And it's down 40, 50%. They keep buying the dip. They
have conviction.
It reminds me of that scene in Tin Cup where he just wants another golf ball. He keeps hitting it right into the lake, and he just asks for more golf balls. Anyway, yeah.
It sounds great.
It's a boomer reference.
Whatever you're referencing.
Anyway,
Gen X.
I think at some point, though, if we go down another 10, 20%, looking for these investors to pack it up, I think will be the next shoe to drop. But it hasn't happened yet.
But sometimes we look at these ETFs, like for instance, last week, obviously, Thursday, Friday, we had such big sell-offs in the market. Almost everything was getting hit. Some of these ETFs were down 20, 30%, like really huge numbers. The next day you look and they're getting tons of inflows. One, which actually is seeing huge volumes today, is SOXL. It's a bullish chips ETF. It's 3X semis. And last week, it got something like $1.7 billion in inflows. Today, the volume numbers are just astounding. It's trading much more than even the highest traded stock, which is NVIDIA. The volume for SOXL is just much higher today. So it gives you a sense of what people are looking at, what they're doing, what they're interested in, and then some of this dip buying, obviously, as well.
Interesting, especially given that the SOX itself is up just by 0.2%. Of course, it's been volatile like everything else. Vildana Hajric, thank you so much. And to that end, when you look at the markets, of course, it's a sea of red right now for the equity indexes. The S&P 500 losing 1.8%, the NASDAQ 100 down 1.4%. But I looked at 24 industry groups, and you actually have chip and chip equipment companies in the green right now, up 1.1% at the moment. I mean, at the moment is what I need to stress because
it's just a snapshot of a moment in
it's
time.
been a crazy kind of day right now. And we'll continue to keep an eye on all these developments. New York crude down at $60 a barrel. The 2-year yield moving up 6 basis points to 3.71%. This is ETF IQ. This is Bloomberg ETF IQ. I almost missed that. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, hit it.
Katie, today we have not only a new ETF, but a new issuer, Lazard. Definitely not a new company, but a new ETF issuer, Japanese equity ETF. JPY is the ticker. It's actively managed. It charges 60 basis points. It was born today. Basically, it tries to outperform the big Japan index, like a typical active fund. Let's look at what it holds. Now, you're going to see stocks here that are Japanese stocks. I will tell you it's a little overweight in financials, and it's going to be a little underweight in, say, communication. So you'll have sector differences, hold 61 stocks, so it's a decent active share. Now, this ETF has no performance, really, so I thought we'd look at Japan in general versus some other countries to see where we're at in terms of Japan, because a lot of people are looking outside of the U.S. right now. Where can I get return? Now, Japan is down 9% year to date, 1 year, sorry. And then this is the China. So China is really beating Japan. And then here's Europe, flat. And then that is the U.S., down 1%. So Japan, the worst of those over the past year, Katie, but that could also spell opportunity.
Absolutely. Eric, thank you. And joining us to talk about this ETF, I'm pleased to say, we have Rob Forsyth. He is Global Head of ETFs at Lazard. Great to see you in person.
Yeah, good to see you as well.
So we're going to talk specifically about Japan, but you're launching 3 ETFs today. Your debut ETFs, you have a Megatrends ETF, the Japanese Equity ETF, and the Next Gen Technologies ETFs. So these aren't, steady Eddie dividend paying sort of haven type ETFs. You really have to have conviction and belief to put your money behind these. And it's a pretty rocky market out there. Just talk to us about this launch and how they fit into this environment, which is quickly changing.
Sure. So notwithstanding the market volatility we've been experiencing these last few days, we're really excited at Lazard Asset Management to be launching these first 3 actively managed ETFs. As you mentioned, there's Japanese equity, ticker JPY, as Eric was pointing out. There is the Next Gen Technologies ETF, which the ticker is Techie. In that portfolio, we have a really experienced team that's covered automation, robotics, and AI. And in that portfolio, we're focused exclusively on the AI tech stack. So, from hardware, such as semiconductor production, through cloud and data centers, all the way through AI applications. And last but not least of these portfolios is our equity megatrends portfolio. The ticker there is THMZ, or Themes. That portfolio really leverages our kind of global reach of securities analysts. And when we are covering these companies across the globe, I think we had 4,500 plus meetings with the management teams at these companies. We're identifying trends. Where's their tech capex being deployed? Where are they making R&D breakthroughs? And it's the identification of those trends that informs how we build out this global equity portfolio.
Okay, so those 3 trends, Japan entered a bear market today. AI, the narrative is kind of on hold as we wait to figure things out. Companies are pulling back on their spending, their capex. And when it comes to themes, the president is upending the global order completely. Was there any deliberation on your part to maybe hold off on launching these ETFs? Is it like an IPO where you want to get that first day pop to really set the tone?
It's a great question. It's unlike an IPO. There was no real hesitancy in launching these products today. We wanted to kind of press forward, provide our investors and our clients with really specialized, focused investment capabilities combined with the benefits that the ETF vehicle has to offer. So tax efficiency, tradability, transparency. It's moving on and upward. The market volatility that we're experiencing today, tremendous amount of uncertainty. Equity markets correlations all go to 1 when you have this type of uncertainty. But if you look at the market environment just ahead of the announcement of the tariffs, we're in an environment in which actively managed portfolios should really benefit. We had increasing breadth, right? A move away from the trade that had kind of dominated markets over the course of the last year or so, which was, really concentrated large cap domestic equity portfolios. That trade began to unwound. Breadth had resumed, dispersion was increasing, correlations were breaking down. And I think once the dust settles and we kind of emerge from this period of uncertainty, I think you're going to find an environment in which actively managed strategies really pay off.
So there's 3 ways to enter ETFs. You can do clones like you did. You can do share classes, which aren't approved yet but are coming, and you can convert. Any thought to just taking some of your mutual funds and just converting them into ETF or adding a share class when that's approved? Yeah,
it's a great question. So most of the strategies that we've launched today are not clones of existing mutual funds. These are institutional investment capabilities that we've managed for many, many years very successfully. But it's the first time they're going to be offered in a U.S. exchange-traded fund vehicle. No mutual funds exist there. I'm glad you asked the question about the conversions, however, because we have announced a mutual fund conversion. In the coming weeks, we'll be launching the International Dynamic Equity ETF. The ticker for that will be IEQ, and that is a conversion of an existing mutual fund. When I think about bringing product to market, a mutual fund conversion is threading a needle. Right. You need to have the right asset base, the right existing investors, the portfolio needs to be compatible with the ETF vehicle. Doesn't fit for all strategies.
Right. So, Rob, we only have about a minute left with you, less than that. I think it's interesting that you're bringing forth these, these thematic ETFs versus sort of going after building blocks, going after the core, launching another S&P 500 ETF. Is that what we should expect from the Lazard lineup going forward?
Expect that going forward. We're going to be specialized and focused in areas of the market, segments of the market in which we have an edge and where alpha opportunities exist, inefficiencies exist, and we can exploit those inefficiencies. We've seen reporting from yourselves, model portfolios, proliferation there, being custom and tailored, and providing kind of new ways to build portfolios, combining active and passive, and using specialized investment capabilities such as Lazard's seem to fit that profile.
All right, Rob, it's really great to get some time with you. Congratulations on the launch. I know it's a rocky market out there. That is Rob Forsyth of Lazard, and you can read about this drill down and everything else that's going on in the ETF news industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. We'll be back at our normal time next week. I can't guarantee what might be going on in markets, Scarlett, because it looks ugly out there.
We don't know what's going to happen in 2 minutes.
Yeah, absolutely. But we do know that does it for this edition of Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett and Eric, and this is Bloomberg.